Welcome back to the Daily Crypto Roundup. Today's market has one clear theme running through it. Crypto is moving higher again, but the industry underneath it is changing fast. Bitcoin has pushed back above $81,000. Options desks are betting on more upside. Coinbase is cutting 14% of its workforce as artificial intelligence starts reshaping how crypto companies operate. One Nasdaq-listed firm has walked away from a huge Bitcoin treasury plan to chase AI infrastructure instead, and Aave is now in court trying to unlock tens of millions of dollars in frozen Ethereum linked to a DeFi recovery battle. So this is not just another green day. This is a market where Bitcoin's strength, AI disruption, corporate strategy, macro inflation fears, and DeFi legal risk are all colliding at once. Just before we get into it, this episode is brought to you by Kraken, our official exchange partner. If you're buying, selling, or building a long-term crypto position, Kraken is one of the most trusted names in the market. The link is in the description, and for any of our listeners that can support the show by doing this, we will drop 20 XRP into your wallet once it's done. Crypto involves risk, prices move fast, and this is not financial advice. The big market story today is Bitcoin crossing back above $81,000. According to CoinDesk, Bitcoin moved above that level during Asian trading hours after briefly dipping earlier in the week, with Ethereum, Solana, and Dogecoin holding steady while options desks positioned for another leg higher. The important part here is not just the price level, it is the behavior around the level. Bitcoin had pulled back, buyers stepped in, and the market absorbed the pressure rather than breaking down. That is usually what traders look for when trying to decide whether a move is just a quick bounce or the start of a stronger continuation. When Bitcoin gets rejected immediately, confidence fades. But when it takes a hit, holds the range, then pushes back through a psychological level like $81,000, it tells the market that demand is still there. And this is where options activity becomes important. Options desks are not always right, but they give you a window into where professional traders are leaning. If desks are bidding for further upside, that suggests traders are paying for exposure to a larger move rather than simply protecting themselves from a crash. It does not guarantee a breakout, but it does tell us sentiment has shifted from defensive to opportunistic. Ethereum, Solana, and Dogecoin staying steady also matters because it shows Bitcoin's move has not completely sucked liquidity out of the rest of the market. In weaker conditions, Bitcoin rallies alone while altcoins bleed. Today, the better read is that Bitcoin is leading, while the rest of the market is at least holding the line. That gives the rally more credibility. But the more interesting macro angle is the inflation story. CoinDesk's other market piece made the point that Bitcoin used to hate inflation, but now it might be reacting differently. Historically, the simple argument was that Bitcoin should benefit from inflation because it has a fixed supply and cannot be printed like fiat currency. But in real market conditions, that has often not been how it traded. When inflation came in hot, investors feared higher rates, tighter liquidity, and less risk appetite. That meant Bitcoin often sold off with tech stocks rather than behaving like a clean inflation hedge. The old market logic was simple. Higher inflation means higher rates mean less liquidity means pressure on Bitcoin. Now that relationship may be shifting. If markets believe inflation is rising again, but central banks are either unable or unwilling to tighten aggressively, Bitcoin can start trading more like a debasement hedge than a high-risk tech asset. That is a major difference. In other words, Bitcoin may not just be reacting to inflation itself. It may be reacting to the market's belief that governments and central banks are trapped. If debt is too high, deficits are too large, and rate cuts remain politically or economically tempting, then inflation becomes less about tighter policy and more about currency weakness. That is the environment where Bitcoin's hard money narrative becomes powerful again. This is why Bitcoin above $81,000 matters more than just a chart level. The market is starting to ask whether Bitcoin is becoming a hedge against the system again, rather than just another risk asset. That does not mean the volatility disappears. It does not mean Bitcoin cannot drop hard if inflation surprises the wrong way. But the narrative is changing. If traders start believing that inflation plus weak policy discipline equals stronger Bitcoin demand, then every inflation scare becomes a potential Bitcoin catalyst rather than automatically being bearish. Now, away from prices, Coinbase has delivered one of the biggest corporate stories of the day. Coinbase is cutting roughly 14% of its workforce, which reports put at around 660 to 700 employees, as Brian Armstrong pushes the company toward what he describes as a more AI-native way of operating. Reuters reported that Coinbase expects the restructuring to cost around $50 million to $60 million, mostly in severance and benefits, with the cuts expected to be completed around the second quarter of 2026. The company has framed this as a response to two forces: crypto market volatility and artificial intelligence changing how work gets done. This is a very important story because it tells us where crypto companies think the next efficiency battle is going. In the last cycle, exchanges hired heavily during the boom, then cut aggressively when the market turned. That part is not new. What is new is the AI language. Armstrong is not just saying the company needs to save money. He is saying smaller teams can now do more with AI tools, and that the company needs to become faster, flatter, and less dependent on big layers of management. Business Insider reported that Armstrong talked about one-person teams and reducing management layers, which gives you a sense of how extreme this new operating model could become. For the crypto industry, this matters because exchanges, wallets, DeFi platforms, analytics firms, and media businesses are all going to face the same pressure. If AI can compress research, coding, customer service, compliance workflows, marketing, and internal operations, companies will not need the same headcount to scale. That is good for margins, but it is brutal for workers, and it changes the competitive landscape. The companies that use AI properly may get leaner and more profitable. The companies that do not may look bloated very quickly. Coinbase is basically saying the next crypto cycle will not be won by the biggest teams. It will be won by the fastest teams. But there is a darker side to that as well. Crypto is already a trust-sensitive industry. If companies cut too deeply, they risk weakening customer support, compliance, product safety, and security oversight. AI can help, but it cannot simply replace judgment in a sector where one mistake can cost users millions. So the question is not whether Coinbase can cut costs. The question is whether it can become more efficient without becoming more fragile. And that brings us neatly to the next story, because another company has just shown how powerful the AI narrative has become. Aave Media, a Nasdaq-listed firm, has scrapped a massive Bitcoin treasury plan and redirected up to $485 million toward artificial intelligence infrastructure. Crypto.News reported that the money is being shifted toward data centers, GPU compute operations, and related AI infrastructure, while the company also plans to reduce around $48 million in debt and liabilities. The market reaction was harsh, with Aave shares reportedly falling about 25% after the announcement. This is a fascinating reversal. Over the last few years, Bitcoin treasury strategies became one of the loudest corporate crypto narratives. Companies wanted to copy the strategy playbook: raise money, buy Bitcoin, hold it on the balance sheet, and let the market reward them with a premium. But K-Wave's move shows that not every company wants to keep chasing that trade. Some are now deciding that AI infrastructure is the hotter capital story. And the fact that the stock fell sharply tells us investors may not be convinced by the pivot, or they may feel the company has damaged trust by reversing its previous Bitcoin plan. The wider takeaway is simple. Bitcoin treasury strategies are not automatically magic anymore. The market is becoming more selective. If a serious company with a clear balance sheet and a credible long-term thesis buys Bitcoin, investors may reward it. But if a company appears to be jumping from trend to trend, first Bitcoin, then AI, the market may punish it. That is healthy. It means investors are starting to ask whether these strategies are real capital allocation decisions or just attempts to catch whatever narrative is hot that month. Finally, we need to look at the Aave story, because this is one of the most important DeFi legal battles happening right now. Aave has filed an emergency motion in New York to lift a restraining notice affecting frozen Ethereum linked to the April incident. According to Crypto.News, The dispute involves about $71 million in frozen Ethereum, with Aave arguing that the assets should be used to restore backing and help affected users, rather than be claimed by outside judgment creditors trying to satisfy judgments connected to alleged North Korea-linked crypto theft. The numbers are huge. The Arbitrum Security Council froze 30,765.6675 Ethereum on April 21st, and Aave says those funds were moved to a designated address as part of a recovery effort. Aave is arguing that stolen assets do not somehow become North Korean property just because an alleged hacker briefly controlled them. The protocol says the frozen Ethereum belongs to users who suffered losses, not to North Korea, Lazarus Group, or any other outside party. It has warned that keeping the funds frozen could delay user withdrawals, damage protocol operations, and discourage future recovery efforts after hacks. That last point is the key. If recovery funds can be frozen and redirected away from victims, DeFi protocols may become less willing to coordinate recovery operations in the future. That would be a terrible outcome for users. The entire point of emergency freezes is to return value to the people affected by exploits. If courts, creditors, and legal claims start pulling those funds in different directions, every future hack recovery becomes slower, messier, and more legally dangerous. So the market today is giving us a very clear picture. Bitcoin is strong, but not in isolation. AI is now reshaping crypto companies from the inside. Corporate treasury narratives are being tested. Inflation may be turning from a Bitcoin headwind into a Bitcoin tailwind. And DeFi is being forced to prove whether decentralized recovery can survive contact with the legal system. That is the real story today. Bitcoin above $81,000 grabs the headline. But underneath it, the industry is being rebuilt. Smaller teams, faster tools, more AI, more legal pressure, more selective investors, and a market that is starting to believe Bitcoin may still have another major move left in it. Drop your thoughts in the comments, smash like, follow, and we will see you at the top.